Good morning from Glendale, Arizona. Last month was Life Insurance Appreciation Month, and I want to continue that theme because I think it's important every month, not just one month. So, what I want to talk to you today was about a life insurance hack. So, we're going to talk about term versus IUL first. And if you want to check this out, you can go to my business partner's webpage, ChatGPT, and run this yourself. But real quick, the pros are for term, pure protection. It covers your income, your household, your house, and your debt, okay? Cons are there's no cash value. It's not an investment account. Well, duh, an investment account, you would put in an investment account, not in life insurance. Now, IUL, the pros, lifelong coverage, as long as premiums are funded. And that's key, because you're going to see why in a minute, because the cons are they're complex. There's fees, caps, and participation rates. And this makes it a much higher cost. So if you have an IUL and nobody has an IUL, I would love to take a look at it and compare the difference between that and what we can do for a good term. Now, the next thing I want to talk about is how much coverage do you actually need? Well, industry professionals, I agree. They say 8 to 10%. I like to go with 10%. Bigger is better, you know what they say. So, why? Well, first of all, let's see, you got your mortgage, right? So, the mortgage, an average mortgage right now in the United States is about $252,000, okay? Then you got debt, all right? Currently that's about $30,000, and that includes auto and credit card, okay? Then you've got the funeral expense itself, okay? And that's about $15,000 on the low end. We'll just stick with that. And then you've got, let's say about your children's education, all right? College. It's about $38,000 a year now, so times 4, that's $152,000. And this is in today's dollars, by the way. And lastly, you've got the survivor income, okay? This is what's going to be paid out to your spouse or whoever your beneficiary is if something happens to you. And let's say that's $50,000 a year. Let's just go 5 years, and let's go, that's 4 years, and let's just say $200,000. So you add all those up, and that comes to $649,000 is the coverage you should have at a minimum, okay? Now, when you do this, you got to make sure you appropriate the right person to be a beneficiary. And the beneficiary needs to be able to take care of the funeral, take care of your debt, pay off the house, and help with the children. So make sure you get the right person for that and have a contingent just in case something happens to that person. Secondly, probably the most important fact is you need to make sure who your beneficiaries, double check your beneficiaries on your life insurance policies. Because if there's a will or a trust, it doesn't matter what you put in that. It's whatever was on the policy when you signed it with the company, because the insurance company is only paying that person. So, until next time.